Well, I mean, whether you're looking at the bond market or the equity market, they're all sending the same signal that you absolutely have this risk of a recession down the line. I think the risk is greatest probably the fourth quarter this year, the first quarter next year. If you just look at the typical lags out of gas prices and Fed hikes, just those two areas alone are going to be shaving about 3 to 4 percentage points off of growth off that area. So I think that's the same signal you're getting here. Overall, if you look at equity markets, they're telling you the ISM probably falls to 50 or sub 50 over the next 2 to 3 months. And in part, I mean, this is what the Fed and central banks have to do to get inflation back under control. You know, while they can't sit there and say their job is to, end job creation for the moment, that is basically what they need to do if they're going to get inflation back under control now.
I think the market had already baked in the idea of 50 basis points. Richard, do you see any need for the Fed to go 75 to demonstrate its desire to get on top of this story? Over the weekend, there were even some economists saying they should go a full 100 basis points.
So I think it is absolutely possible the Fed decides to hike by 75 basis points at this or the next meeting. I don't think they need to. I think what the communication is going to be, and I think what you've heard so far, is that extending the period at which they're hiking 50 basis points a meeting, already we think the Fed will take rates to 3% by the end of this year and then keep hiking by 25 basis point increments past that. That still makes it the fastest pace of rate hikes out of the Fed post-Volcker. So, it's nothing to be flagged at here in terms of where we're going. But I think the point is they are significantly behind the curve. And if you were taking just where the Fed should have hiked right now, they should hike by 200 basis points right now just to get to where their typical reaction function would take them to. So that's basically, if you want a metric of how far behind the curve they are, that's where they're at. Now the question becomes, do you need to do that all at once, knowing that that's going to have a much more significant impact to growth that may actually make you overshoot to the downside in terms of what you do to inflation and growth? Or do you try and thread this needle? The problem is each month goes by, each CPI goes through, and it's clear that we're sort of missing the mark by a lot more than a needle here.
Richard, if we just delve into that number then on the inflation print, the 8.6%, it was a miss by 0.3%. We often talk about the central bank not reacting to one piece of data here if you do get a miss. Just put this in context, because some think that it might be a turning point at some stage for inflation that must be coming soon. Others still think we could be tracking up to 9%. So what's your view on where we're going with inflation?
I think we really can't be focused on that headline number. So, I mean, this whole debate as to whether it was going to be peak or not, I think really misses the point. The point is, if you look underneath there, yes, we've got food, we've got inflation, the base effects going through. If there's about 16, 17 major components that make up core inflation, 2/3 of them are running more than twice the 0.2s that you would need month over month to actually hit the Fed's goal. So this is not, if you look at the year over year, and if it only were to sit at 8.6 or come down to 8, that would be a huge disappointment. That would suggest that those month over months are running much faster than they should be. So I think we're at a point where you need to really ignore the headline number, look at those month over month figures. And that's where, when you went through this, core inflation of 0.6, energy at 3.9, food inflation just starting to go through. Within those core prices, you're seeing shelter only half of the way in terms of distributing what's normally a lag between the shelter and the OER component in terms of those increases in month over month. And then beyond there, you're seeing significant pass-through across core prices. You're seeing correlations with food and energy. So while you would normally look through those components because they're transitory, that's not what you're seeing in this data. This data is telling you these expectations are becoming embedded across a large number of components, and it does mean you need to be extremely aggressive. It means the Fed and other central banks need to be hawkish in their communication, because you need to keep this anchored now so that we aren't having to deal with this for the next 2 to 3 years.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.